Imagine having a penny that doubles in value every day. Can you grasp how much it would accumulate to in just a month? An astounding over $10 million. Compounding is like this magical snowball effect in finance. It's the process where your money earns interest, and then that interest earns more interest, creating a continuous cycle of growth. Today, we'll unravel how this concept can help you become wealthy. Welcome to Wealthway as we journey through the world of financial success and the incredible power of compounding. In this video, we'll dive into the concept of compounding, explore its application in different assets, understand its impact on personal finance, and draw inspiration from key takeaways from The Compound Effect by Darren Hardy. If you're eager to unlock the secrets of wealth creation and witness how small actions can lead to big financial gains, make sure to hit that like button and subscribe for more insightful content. Have you ever watched a snowball gather momentum as it rolls down a hill? Well, that's a lot like how compounding works with your money. Compounding is the process of earning money on your money. Picture this. Your money grows bigger and bigger as it earns interest, much like that snowball gaining size as it rolls downhill. It's a concept that can significantly impact your wealth, and today, we'll uncover just how it can help you achieve financial success. But hey, I'm not the only one talking about this. Have you experienced the power of compounding in your own life? Maybe you've seen your savings grow with interest, witnessed your investments flourish, or supercharged your business growth through investment. We'd love to hear your stories, so make sure to share them in the comments below. Now, let's break down how compounding works in practice. The secret sauce here is time. The longer you let your money grow, the more impressive the results. That's why starting your investment journey early is crucial. Let's illustrate this with a hypothetical scenario involving our friends, Alice and Bob. Imagine Alice starts investing $2,000 per year from the age of 25 and stops at 35. Bob, on the other hand, begins investing the same amount, but only at age 35 and continues until 65. Both earn an average annual return of 8%. Who do you think ends up with more money at 65? Well, surprise! It's Alice! Even though she invested for just 10 years compared to Bob's 30, her money had more time to compound and grow. Alice walks away with an impressive $372,000, while Bob has $279,000. That's a significant difference, and it showcases the power of compounding. Now that we've grasped the essence of compounding, let's explore how it can work wonders for your wealth creation. There are two main approaches: investing a lump sum amount and making regular contributions. Say you have $50,000 ready to invest for 30 years with an average annual return of 10%. Any guesses on the final amount? Drumroll, please. Your $50,000 investment balloons into a staggering $863,000. It's like watching your money grow wings. But wait, there's more. Regular contributions are equally impactful. Picture investing $500 per month for 30 years with an average annual return of 8%. Can you believe it? Your monthly $500 turn into an impressive $1.1 million. That's the magic of consistent contributions and the power of compounding. Whether you're starting with a lump sum or making regular contributions, the key is to give your money time to work its magic. Remember, compounding isn't a sprint. It's a marathon that can lead you to financial success. Comment marathon below so I know you've reached this part. Next, picture this. You're a part owner of a thriving company, and its success fuels your wealth. That's the beauty of investing in stocks. When you own shares, you're not just a bystander. You're reaping the benefits of capital appreciation and dividends. And here's where compounding steps in. Capital appreciation, when your stock's value climbs over time. Dividends, when a portion of the company's profits flows to you. But wait, there's more. By reinvesting those dividends, your earnings start earning. And that's when the real magic happens. Let's crunch some numbers. Say you invest $10,000 in a stock with a 3% annual dividend yield and a 10% yearly return. If you reinvest those dividends over 20 years, your investment blossoms to nearly $53,000. Skip reinvestment and it's only about $38,000. The lesson? Compounding through dividend reinvestment multiplies your returns by letting your money work harder and smarter. Stocks are undoubtedly one of the top assets that leverage compounding. Remember, it's all about capital appreciation and dividends. When these two forces join hands, your wealth can soar. Now, let's talk about another incredible asset. Now, let's meet mutual funds, your ticket to a diversified portfolio managed by experts. With mutual funds, you're not just investing, you're becoming part of a pool that owns various securities. So how does compounding work with mutual funds? You've got two powerful options: reinvesting dividends and systematic investment plans or SIPs. Reinvesting dividends means letting your earnings snowball, growing your initial investment and each dividend payout. And then there's SIPs, a disciplined approach where you invest a fixed amount at regular intervals, no matter the market's mood. Imagine investing $100 every month in a mutual fund through an SIP. This technique eliminates timing stress, benefits from market volatility, and sets the stage for compounding. Averaging your purchase price over time helps minimize risk and amplify returns. Of course, before diving into mutual funds, research is key. Analyze the fund's strategy, review its performance history, and be aware of expenses and fees. Remember, while mutual funds offer great potential, they're not risk-free. The power of compounding is undeniable. Whether you're enjoying capital appreciation or savoring dividends, plus, with SIPs, you're investing with discipline and reaping the rewards. If you're hungry for more financial wisdom, drop a comment below using the word more. Imagine building your fortune not just brick by brick, but property by property. That's the beauty of real estate, an asset class that thrives on the power of compounding. Think about owning properties that generate rental income. Now, take that income and reinvest it to acquire more properties. As your real estate portfolio grows, so does your cash flow and, of course, your wealth. Let's draw inspiration from the real estate tycoon, Donald Bren, whose journey from a small loan to a vast real estate empire is a testament to the potential of compounding. His strategy? Reinvesting rental income, focusing on quality and creating communities, not just structures. Brent's story showcases how reinvesting rental income can transform your real estate portfolio into a source of passive income and financial freedom. It's a lesson for aspiring real estate investors to nurture their properties and watch their wealth multiply. Now, let's turn our attention to bonds, a pillar of stability in your investment arsenal. While bonds may not yield astronomical returns like stocks, they offer security and consistent income. Compounding isn't exclusive to stocks and real estate. By reinvesting interest payments from your bond investments, you can slowly but steadily build your wealth over time. Bonds may not skyrocket like stocks or real estate, but they provide stability and a reliable income stream. Now, let's hear from you. What's your take on bonds? Do you believe that they play a valuable role in a diversified investment strategy? Share your thoughts in the comments below. Luck, the unpredictable factor in the investment equation. While compounding is a powerful tool, it's essential to recognize the role of luck and risk in the investment landscape. Meet Sarah, a diligent investor who faced an unforeseen setback when one of her chosen stocks plummeted due to an unexpected scandal. Sarah's story emphasizes that alongside a well-thought-out strategy, understanding market unpredictability is crucial. Diversification is your armor against risks. By spreading your investments across various assets, industries, and regions, you can mitigate the impact of unforeseen events. Imagine shedding debt burdens like shedding old skin. Debt repayment, when coupled with a compounding effect, can lead you down the road to riches faster than you think. Debt, especially those with hefty interest rates, can weigh you down. But by making larger payments and consistently reducing your principal balance, you can dramatically shorten the payback period and save a significant amount of interest. Let's consider an example. Imagine having a $30,000 student loan with a 6% interest rate. If you make only minimal monthly payments, it might take over 2 decades to repay. But by leveraging the compounding effect through higher payments, you can break free from financial burdens sooner and redirect those funds toward wealth-building endeavors. Now, let's talk retirement accounts, the secret weapon for compounding your way to a secure financial future. When you invest in a retirement account, you're using pre-tax money. This means more money to invest and compound over time. Plus, employer matches, essentially free money, can supercharge your compounding power. Imagine investing $500 per month with a 50% employer match. Over 30 years at a 7% annual return, you could amass over $1.2 million. Retirement accounts offer a unique combination of consistent contributions, compounding, and employer assistance, a surefire way to wealth. We've discussed assets and tools, but remember, becoming wealthy isn't just about the choices you make. It's about your mindset and strategies. Let's dive into 5 key takeaways from The Compound Effect by Darren Hardy that can amplify your understanding of compounding and wealth creation. Think about the immense power of achieving remarkable outcomes through tiny, consistent actions. The compound effect teaches us that every small decision we make, regardless of its size, has the potential to impact our lives in profound ways. Think about your fitness goals. You don't have to overhaul your entire routine overnight. Instead, focus on those small, consistent choices, like a daily 30-minute workout or opting for a nutritious snack. These seemingly minor decisions, made consistently, accumulate over time, leading to improved fitness, heightened energy levels, and even an uplifted mood. Remember, it's the sum of these actions that yields impressive results. Tracking your actions and results is crucial for sustained success. This takeaway emphasizes the importance of measuring and documenting your progress. Consider your journey to save more money. Start by diligently recording every single purchase over a month, no matter how trivial. This eliminates your spending patterns and guides you toward potential savings. Transform these insights into a tailored budget that aligns with your financial goals. By continuously tracking your progress and refining your strategies, you'll remain on course toward your savings objectives. Our third takeaway encourages us to embrace a fundamental truth. We hold the reins to our own lives. Taking responsibility empowers us to shape our destinies. Success isn't a roll of the dice. It's a result of intentional choices and actions. By recognizing that you're in control, you become proactive in finding solutions rather than dwelling on problems. Seize the opportunity to make deliberate choices that lead to the outcomes you desire. This mindset shift transforms you from a passive observer to an active creator of your own life, paving the way for triumph over obstacles. The compound effect advocates for the mastery of a few essential areas rather than dabbling in countless endeavors. This concept revolutionizes our approach to success. Success isn't about knowing everything. It's about honing your expertise in a select few areas. Whether it's a skill, a business aspect, or a crucial habit, focusing your energy on these key domains fosters excellence, consistent actions, continuous refinement, and unyielding commitment to improvement establish a strong foundation for long-term success. Remember, success thrives not in juggling numerous opportunities, but in mastering the pivotal ones. The final takeaway introduces us to the transformative power of gratitude. Expressing appreciation amplifies positivity and attracts abundance. Gratitude isn't just a feel-good sentiment. It's a magnetic force that draws positivity into your life. Take a moment each day to reflect on the people, situations, and opportunities you're thankful for. By cultivating a gratitude mindset, you invite more blessings and opportunities to unfold. Embracing this practice sets you on a path toward abundance and cultivates a joyful outlook on life. As we wrap up our enlightening journey through the world of compounding and wealth creation, remember that the key to financial success lies not only in the assets you choose, but also in your mindset, strategies, and the consistent actions you take. By harnessing the power of compounding and applying the key takeaways from the compound effect, you're well on your way to achieving your financial goals and building a brighter future. Thank you for joining us on this enriching journey. And remember, with the power of compounding, the sky's the limit. Until next time, keep compounding your way to a prosperous future. Don't miss our next video where we delve into another exciting topic that can turbocharge your financial journey. Hit that subscribe button and turn on notifications to stay updated.